Okay, let's see if we can get where we need to go here. My camera's on for some reason. My slides are hiding. Let's see what we can find. So we're going to talk about 3 topics, all to do with money. And I'm going to try to make it fast again. I know we just have a week to do this, so we're going to try to stuff it all in. I'm sorry this is a day late. Yesterday was my birthday and I decided to take the day off. So I am back in action now, and we're going to talk about financing and funding. We're going to talk about pricing. We're going to talk about where to get money and how to manage the money in your business. So I don't even know what order these are in. I just pulled them out of 3 other slide decks, and we'll just kind of get into it and see what we got. Pricing. I wasn't sure if I was going to talk about this or not, so you probably noticed it wasn't in your quiz if you've already taken it. But pricing is so important, and it's something that people, I think, have misconceptions about. And so talking about pricing, at least a few specifics, I think is important. So it's both an art and a science, something to think about. We'll talk about more in detail. There's a lot of things that go into pricing. It's not just, let's mark this up and we can make $20 a thing. I saw a lot of people talking about that in some of their research projects where they're like, well, you know, it only costs $20 to make it, and we can charge $50, so we'll make $30. Right? Not always that straightforward. You really have to think about, is that the right price, that $50? What's that saying to customers? So we'll talk about that. Influences every aspect of a small company. So when we're talking about, just like we were talking about, you know, the name and the target market, same type of thing. You know, if I'm charging a Lexus price, if I'm charging, you know, a Ford, what does my mother-in-law have? One of the tiny Ford prices, right? Then Ford Focus or whatever, then it's a different experience, a different expectation. So it influences every aspect of a small company, needs to match up with the other things you've set apart, especially with your target market. Signals value to customers. Both math and psychology are involved. And it has a greater impact on your profits than unit volume or reduction in costs. It's going to be key. You need to get this right. You need to not just say, hey, you know, other people are charging this much, so I'll charge that much too, right? Or people are willing to pay this much, or I want to make it a really good deal. Ironically, I see that more than anything. Like, I just want to make it really inexpensive. I don't want to rip people off. Okay, well, there's much more that goes into pricing. It just seems, I don't know where all the stories or the expectation of the big bad company ripping people off comes from. I feel like that's so uncommon, and usually it's the other way around. I mean, as a business owner, I would say I charge too little most of the time. If I look at, you know, my costs and my expectation for payroll and high-end products and great location and, you know, nice finishes and all those things, like, I hear ya. I have that feeling too. Like, I want to charge what I want to pay, but sometimes the industry and the cost and the structure don't call for that. And so you have to, we'll talk about maybe taking price increases and how you handle that as well. Let's see. So the impact on profitability, like it said, that last bullet point there, your price is significantly affects your profitability versus your volume, adjusting your volume, your fixed costs, or your variable costs. So things to think about when you start playing with your price. That's really usually the last place you want to make adjustments, because there's so much that goes into it and so much that is signaled by a price change. Part of your price is your image. You're also going to look at your competition and how it describes your value. So when you start raising your price, it can increase your sales revenue significantly. Sorry, I'm just going to adjust these slides while we're going through them. Price conveys your image. So so there's an example story that I read in one of the textbooks through the years that really stuck with me, and it was a lady that made, and I think this happens a lot of times with handmade goods, right? I make this handmade belt buckle. It's sterling silver. They're very beautiful and custom. You know, but I want to charge, you know, an affordable price, so I charge $50 for them. I'm just not making any sales, right? You know, people I guess, aren't getting the message that they're high quality, very unique, very, you know, time intensive, because I'm not pricing it that way. And so nobody's seeing the value in them, the quality, things like that. The people that are going to be interested in that type of custom piece aren't shopping at the $50 price point. They're shopping at the $500 price point. And so she's not making the connection with the right target market. The target market she's connecting with $50 thinks it's too much because they wouldn't pay that much for a belt buckle, even though it is, you know, high quality and customized. And so she's hitting those shoppers. What she needs to be hitting is a higher end shopper that is willing to pay for that and can pay for that, you know, has the means to pay for that. And so conveying image, she changes prices, immediately attracts a different target market that is her target market, that appreciates and can pay for that customization and quality, and sees the value in it. And then all of a sudden, you know, it takes off. Not everybody can do that. I can't, you know, pour a candle today and say this is a $50 candle. You know, there has to be something behind it, right? Her product was high quality, time intensive, you know, customized, unique. So it made sense. There was extra value in there, extra quality, and the benefits. She just needed to portray that image then to hit a target market that made more sense for her. So understanding your target market, identifying how customers are much they're willing to pay rather than how much to charge. You know, really understanding, again, your target market and what they're willing to do. Then also gauging your competition, right? I can't, you know, even if I'm in that high-end customized belt buckle market, you know, I do have to know a little bit about that, right? She was down there with people buying belts at JCPenney's, right? That didn't make sense because she was pricing herself out of that market. But when she starts looking at the customized belt buckle market, then she gets a feel. Okay, this is what I can charge. This is what those type of shoppers are looking for and willing to pay. So you still have to take into account competitors' prices. You don't have to match or beat them. I see over and over and over again in students' works where they want to beat their competitors' prices. You know, I'm going to give this great healthy food. This always happens in a restaurant, food truck, catering type of great healthy food, high-end ingredients. They're going to be it's going to be really inexpensive. Well, there's probably a reason why those aren't really inexpensive. And I don't think it's just because that food truck's trying to make a ton of money. I mean, it's okay for them to make money so they can stay in business, but probably there's additional costs. So understanding competition, not necessarily to match or beat the prices. You just need to figure out what sets you apart, what's your competitive advantage, how are you differentiating your products and services, and then price accordingly, right? Do not start a price war. Getting in there and trying to undercut your competitors, especially if they're bigger, if they're more established, is just going to hurt you, right? I see over and over and over again people in my industry here in Wichita, Kansas, that you know, want to do like a Groupon or want to do something, not so much anymore, that's kind of died out, but want to do a really inexpensive, you know, starter deal to get people in, but they can't sustain at that price level. It's not sustainable, or even, I mean, it doesn't even make sense for a short term. And so established competitors, like our business, you know, we just outlast them, right? I mean, it sucks, and you know, people go over and try them and maybe don't come back, but it just hurts the market as a whole. You know, it devalues services. And there was a time, you know, probably 5 or 6 years in, maybe 5, where that was just rampant. Like, everybody was running a Groupon. So all of a sudden people thought massages were only worth like $25 or $30, which, you know, isn't sustainable. Me even paying a living wage, even paying minimum wage sometimes. I mean, you have to pay for your overhead and all that stuff, and all of a sudden, you know, nobody's making a living, and it's the cost is much more. And so don't get into a price war. Don't have your strategy be trying to undercut your competitors. It'll just ruin it for both of you. Like, you might put them out of business, but probably you'll go out of business too. Focus on value, figuring out the right price for your product or service. This is just like when I asked you that trick question about, tell me what is the best business structure. I caught a few of you, right? Because there is no one best business structure. It depends. And that's the same thing really for your price. Like, there are different things built into it, right? You have to know the financial part of it. You have to know how much it costs you to make it. Make sure you price in your time, that you spend on it. I don't know how many times, again, crafters, things like that, where they price all the supplies that go into it, but don't take into account it takes them 4 hours to make it, right? And they don't pay themselves, and all of a sudden they're charging $5 for an item that at minimum wage they owe themselves another $30 for. And so it's silly. They're not getting paid for their time, and that doesn't make sense business wise, maybe hobby wise. So you're figuring out your pricing, you're figuring out what your competitors are doing, and you're figuring out what kind of image and value, what makes you different, how you're going to price that into there, and figure out a price from there. Value is not synonymous with low price. Again, low price, playing that value game, playing the cheapest on the block, is a very specific niche strategy, pricing, target market. That's Dollar Tree. If you are going to figure out a way to get factory seconds, aftermarket, inexpensive things, sell in a huge enough volume to make that work, then maybe that could be your strategy. But there's a lot of things that go into it, and it isn't just like you feel like you should give people a good deal. Just throw that out of the pricing equation altogether. Something that people are really, as small business owners, having to think about now. I thought about just deleting these slides because they're not really in the pared down version of pricing, but it's so relevant right now. Most businesses with supply chain issues, with staffing issues, with all kinds of things going on, COVID situations, they're really having to think about rising costs and how do you work that into pricing. Talking to customers about it, adding maybe just a temporary surcharge. Maybe you can figure out a way to improve efficiency so you can keep it on your side and not have to change your prices, absorbing those cost increases, eliminating discounts, coupons, and freebies. We saw that with Hobby Lobby. They eliminated their every week 40% off coupon. Customer, every time I go to Hobby Lobby, I'm a Hobby Lobby shopper. There's still people there, tons of people there all the time. They probably grumbled about it, but it didn't stop them from shopping there. So maybe you need to think about, if you need to eliminate some of your discounts, coupons, and freebies. That's something we did pre-COVID. We had a couple of discount days post-COVID, and people still ask about it. We don't. And so people would love it if I would still charge that price 2 days a week for massages, but with staff shortages, with increased cost in our newer location, with increased expectation from staff for wage increases, just with everything costing more, it just isn't possible to charge that price anymore. And people understand and they still come, but they still ask. Maybe find a different raw material supplier if that's possible. Raise prices incrementally and consistently so it's not such a shock like, hey, and now our prices are 50% higher. If you can take maybe a yearly price increase to keep up with those changes, that is something honestly that we didn't do, that we haven't taken a price increase for quite some time. And that's cut into our bottom line as we absorb the cost. And I've been surprised that customers have been very nice about it. Some complain or maybe shop around for a better price, but mostly people understand that you have to do that at some point. Maybe this is something we did do previously, so we haven't taken a price increase recently, but we did modify our products and services to lower the cost. So we changed up some of our services to make them not last, because they were tending to last too long. So when you're a service-based business, right, I'm paying my employee hourly. So if they are doing a service for an hour, I have to pay then that's my cost there plus product and overhead. And so if I can shorten up how long it takes them to do that service, maybe modify it a little bit, then they could do more services. I can not my wage cost is less. So maybe that's something you do, or you can change sizes. So right, you keep your pricing structure, but you scale back the size or the fill or something like that. which is the next one. Differentiate your company and its products and services from the competition. This is when you're looking at how to change prices or increase prices or absorb costs or whatever. It's a great time to change up what you do too, right? So maybe I have to increase my costs have increased, so I have to increase my prices, but maybe I can, also increase value or make some changes that will make it more valuable to customers so they won't really mind that price increase. Try to anticipate when things like this are coming. I was watching 60 Minutes on Sunday, and one of the toy makers said he ordered Christmas items back in May, anticipating, supply chain issues or shortage because of COVID, and still is having issues. So, try to be on top of your game and be forward thinking and strategic. And always emphasize, your benefits, your features, your value, to your customers, so they really, so they can be accepting and reasonable about price increases. Things to think about with prices: there's usually a price ceiling, right? What will the market bear? I can't charge $1,000 for a pedicure. It's beyond my price ceiling. But that changes, and I think now I could probably have an $85 pedicure. I do actually have a mani-pedi that costs $105, so, which I would have thought was absolutely insane when we started this business. Price floor, what are your costs? You have to know, like, I can't really charge below this. I'm going to lose money per person, and now you have an acceptable range, and then you figure out with your image and value and customers and competitors where you fall. There's different types of pricing strategies depending on where you're at, right? If I'm bringing in a new product, then, it depends on what kind of product it is, right? Revolutionary, evolutionary, me too. If it's something that's already out there, then I probably have to price pretty close to my competitors, making sure that my costs and things are in checked, and that makes sense. If I'm not really bringing something that's significantly new, if I'm evolutionary, so it's a new and improved product, right? So then I got a little bit more leeway. I got some more features, some more value. If it's revolutionary, something that's brand new, you can't get anywhere else, obviously that gives you a little more leeway. And as sucky as you think, like, why are they charging so much for this drug or this phone or this brand new thing? Well, they put all the R&D into it, right? They probably, maybe they spent the last year and a half perfecting this brand new product. Now they got to pay that back, right? I mean, there has to be some incentive for spending all that time and money and risk, and probably failed on 6 other products that didn't even pay back the R&D. I mean, that's how a company works. And so, it's not because a company is bad or horrible or ripping people off. It's how the cycle flows, right? If I want to encourage a company to continue to make really cool new products or really, beneficial new products, then there has to be some payoff for the ones that actually make it and that people want to buy. I mean, we saw that throughput, right? Those companies are pumping a whole bunch of products that never even make it to market, and there's cost associated with that, and they have to do that because we know failure is part of the development process. So yes, it might not make any sense that this new product costs $1,000 for the new iPhone or whatever, and but how many people did they pay? How much R&D? How much research? How many things didn't work that went into that really cool new phone? I mean, I don't know, and maybe they are a total rip-off job, but I have to assume that most companies, are making smart business decisions about that, and it has to do with their process of developing a new product and the failures that came before that. Maintaining market share as competition grows, so your price may have to shrink or become more manageable, right? I'm not going to be able to charge $1,000 for this phone when my competitors come out with something similar. So, my price shrinks down. I'm developing that evolutionary product, right? I'm doing the new and improved version, the iPhone 6 and 7 and 8, and the Samsung S20 or whatever. So, profits are, you want to earn a profit, you're going to have to shrink it as it becomes more common in the marketplace. But when you're introducing new product, depending on where it falls in that spectrum, you can maybe charge a pretty nice price. There are also other pricing strategies. Maybe, like I mentioned, life cycle pricing. as it becomes more commonplace, more substitutes come to fruition, then your price comes down. Life cycle pricing, penetration pricing. Maybe I charge, for a product something like I think Square, right? They didn't even charge for that initial little thing that you just plugged into your phone. It's much different now, but you get the little thing that plug into your phone. It's free. They didn't charge penetration. They want everybody to have a Square. So you start using their service, and then they're, earning some money on the fees. They're earning money on, now I want the Square setup. I'm going to use it for payroll. I'm going to use it for a loyalty program, and now I'm going to start paying some monthly subscriptions. So penetration, maybe that works for you, depending on what kind of product or service you're trying to do. I like to discount pedicures at the very beginning of the season, right? Because the first pedicure of the season, usually, if they enjoy it, determines where they're going to get pedicures for the whole rest of the year. So if I run some great specials when it starts getting warm, hopefully, and for me, weather makes a difference too. I love it when it gets warm by spring break, if I'm lucky, in March, right? But somewhere in April, for sure in May, maybe in June, I figure out where I'm going to start doing those first pedicure of the season deep discounts, get in here, and now you'll come back all summer. And then skimming. So sometimes, again, like what I mentioned, you want to make your money back up front. So I'm going to charge a bunch up front, and then we'll scale it back. But I want to get as much money as I can get from the first adopters to pay back maybe some of my costs. So pricing, we've done it it still took me 20 minutes. Anyway, so how do we get some money, right? So I got my prices figured out, or I got an idea of what I need to at least think about. I was just going to use my Excel spreadsheet and figure out my costs and then, double it or something, right? But now I think, I know I have to go in and do some more figuring and thinking and matching up. I mean, the whole key to entrepreneurship is, like, if you love puzzles, putting the puzzle pieces together, right? I figured out this idea and these people that want to buy it, and I have to figure out what they'll pay and how that looks and what that does to my whole scheme, and then I have to go back and fit this puzzle piece in here because I'm not, so a lot of iteration to this as well. So now I need to know, like, how do I get this started? It seems like it's going to work, but I don't have money, so what am I going to do, right? This is really critical. Just like we looked at the right form of ownership, and we're thinking about the right location for our business. Where am I going to get my money can really make a difference too, especially if we're going to, get capital from equity. So now I'm bringing on partners and really having to think about that. The money is out there, just knowing where to look. It takes time and effort. Somebody's just not going to come offer you money. You're not going to pop up your website and customers are just going to start buying. I mean, it's going to be hard work, just like, maybe if you were listening to some of those podcasts, you heard about how that works. Creativity counts, just like in every other part of entrepreneurship. You're going to have to go out there and maybe figure out a unique way or something interesting that will work. I know the lady that opened the hair salon next to me, she tried something that I'd heard people try before. If you spent like pre-bought $1,000 or maybe it was $10,000 worth of services, then you can name a service. I don't know if it worked or not, but I thought it was really interesting idea, at least, right? So get creative about it. Obviously online puts you in connection with much more opportunities for financing, more people. You're not having to network geographically. You aren't limited anymore. And so getting out there and seeing what's available. Business plan competitions, we have the Shocker New Venture competition here that comes with money and mentoring and just connections with people that could possibly be investors, maybe just angel investors, or want to partner or be good resources. And so the secrets to successful financing is getting out there. Be prepared before you approach lenders and investors. A lot of you listen to that Gimlet podcast where how not to pitch a billionaire or whatever, and you kind of got a feel for, whoops, but even the ones that become successful have done stupid stuff like that. So getting prepared, getting practice, knowing your audience, figuring out how to really approach it is important. Finding a investor with the right chemistry. I mean, there were if you listen to the second season of that Gimlet podcast about the dating ring, they were in a situation where somebody offered them some money, but it seemed like there were strings attached that weren't going to work for them, and so they declined the money. And that's scary to do, but it wasn't the right fit for them. Played an exit strategy. When you guys listen to the franchise video, it seemed like a lot of you, it hit home in terms of the curly haired guy. I think his name was John, and how he said, when you get into it, if just in case it doesn't work out, have an exit strategy. Have an exit strategy anyway. I will tell you 100 out of 100 times, I did not do that. I don't know how to get out of this business. If I want to, I've been in it I'm in my 13th year, and it might be time for me to think bigger or differently, or to expand, or to spread my wings into something different, but I don't really have an exit plan. And so building that in 13 years in is a lot harder than if I'd done that up front and thought about it, and then I would kind of know. I mean, I've had ideas of where I'm going, but they haven't panned out exactly. And so now, it's time to relook at what would be my exit strategy. So things to think about. When capital gets tight, bootstrap. Figure out ways to do things cheaper. That's what the creativity, entrepreneurship, and startup is all about. You're probably going to have to look far and wide for the financing to launch your business. It's not just going to be run down to the bank and get a loan necessarily. Something to remember is it's not usually just one source, right? You're usually layering financing. You're piecing it together. So I'm going to get capital from many different sources. I'm going to have some money myself. I'm going to get some from friends and family. Maybe I'll get a small loan. Maybe I'll take on one equity investor. Maybe I'm going to have to use some credit cards. Maybe I'm going to have to sell some accounts receivable. I mean, I don't know what all will be involved. I'm going to do some pre-sales. You're going to have to, pound the pavement and get creative probably. And almost all companies start with a layered piece together financing. You're going to get it from two different options. It's going to be equity or debt, right? You're either going to pay it back, or you're going to take partial ownership of your business. So two options. Equity capital. So this is my personal investment into the business. That's the first place you look. Let me say that again. The first place you look is in your own bank account, in your own assets, your own savings, in your sock drawer, wherever you keep that change. You're going to cash in your 401k. You're going to, I'm not saying all these are the smartest things to do. You're going to, get the bonds that you bought from the bond sales that you used to do when you worked at the aircraft company. Speaking to myself, you're going to come up with some money. You're going to sell some stuff. You're going to figure that out. No one is going to put money into your business, is going to lend you money unless you have skin in the game. I mean, if you have nothing to lose other than a couple of years of your life and maybe a friendship or two because you can't go out on the weekends, I'm not getting into that, right? You gotta want it, and you gotta put some skin in the game, and that has to be some money on the line, right? Equity, it's not repaid with interest like a loan. It's not debt financing. These investors are assuming some risk for their investment. They know if it goes belly up, you don't owe them anything. But if you do well, then they're expecting a return on their investment. You're also giving up partial ownership of the company. If you've watched Shark Tank ever, so a couple of the pitches, you're wanting this money, and they're now part owner in your business and have a say in it, and whatever else you figure out when you do that. Debt capital must be repaid with interest. It's that loan. It's a student loan. It's a car loan. It's a house loan. You owe this money back. It's carried as a liability on your balance sheet. Sometimes it's hard to secure equity financing. Sometimes it's hard to get either kind of financing if you don't have any track record, if you're brand new. So a lot of times when you're starting up, it's coming from your own savings, and it's friends and family. You're calling grandma and all that stuff and figuring that out. It can be expensive, especially for small companies that it's pretty risky. They're going to charge you, interest rate that reflects the riskiness of your business. Getting money from yourself. How many times I would say that? You better get your money from yourself. Bootstrap. Find creative places to get it. Maybe you, when you're setting up your business, you talk to your lawyer and you're like, hey, you interested in investing? Do you know anybody interested in or involved in this industry? Maybe your accountant does. You're getting into angel investors now. But they're going to expect you to put some in as well. Sources of financing, again, look at this. So we're personal, family, savings, owner, friends and family. A little bit of bank, credit cards. I mean, it can be expensive financing, but it definitely is a short-term bridge type of financing. Make sure when you get grandma's $20K, you better make sure that she can afford it, that this isn't going to ruin your relationship with her, that she knows when she's going to get it back, or if she owns part of your company. I mean, if you get Uncle Stan's $10,000 and he shows up to work on Monday and thinks he's running the company with you, like, you better get that clear up front. And I know that'll be hard because, like, grandma just wants to help you, and I'm sure it's fine, but it might not be, even with your parents. I mean, I own my business with my parents. They were my initial investors, and we all own a third of the company. And, understanding what that means in decision-making time, you better know. You better have that articles of incorporation and that, members agreement, so you know who gets the tax benefits, who gets the money when it comes in, who gets to decide who gets paid what and when you get a raise, and how you can get out of this, part of your exit plan. Be really careful, because if it doesn't go well, if you lose grandma's $20K and she can't, pay for her food, I mean, you probably are in trouble with a lot of people. So choose them carefully, make sure it's strictly business, make sure they know what they're getting into, have a plan, settle the details up front, have a contract, treat the money as bridge financing, something, if you're not wanting them to be your business partner, let them know, hey, I need this until I get my first big sale, which should be coming in 6 months, and then I'll pay you back with those proceeds, payment schedule, exit plan, figure out how that's going to work. Crowdfunding. We're looking at this with Kickstarter, something that's out there. Takes quite a bit of marketing skill, I would say. If there's something that you're learning from looking at the ones that were really successful, or the ones that really even aren't successful, if there's a really big, the pitch of it is pretty intense. It's pretty amazing. And so that's how they're getting crowdfunding, figuring out if that makes sense for you. But, every person puts in a little bit of money, right? They see what you're going to do. They think it's cool, and they get something back from it. Not part of they're not equity investors anymore. They just, I get a discount on the first ones that come out. I don't know how many of you have tried crowdfunding. Have you gone on Kickstarter? Indiegogo has something too, but crowdfunding, I think I did on Kickstarter. It was like a Lego strip. Anyway, so you would just I crowdfunded it. It wasn't that much, it was like $40, and I was getting it as like a Christmas present, which of course it didn't come until February of the next year, and by then it was available on the Walmart shelves. So you're taking that risk, putting that money into it, and it didn't work very well either, but it's kind of interesting. I think if you maybe found something out there, you might like it. Accelerators, we learned about accelerators if you listen through the Gimlet. There's a lot of they're groups of startups. We used to have one at Wichita State, but I don't think we do anymore. It was in the basement of Dublin Hall, and small businesses, they would get space and sometimes investment or mentoring, things like that. So you might find an opportunity there. They help you connect with people that might have seed capital. They give you structure. It's a short 3 years to 1 year, or 3 months to 1 year. Something to check out. Angels, these are the wealthy people that are interested in getting involved in entrepreneurship. These are people probably here in town that work at Coke or Coleman or Spirit or aircraft companies, right? They're doing well. They've been successful in their career. They're maybe either getting to retirement age, or they're at a point where they've found success, whether that's earlier or later in their life, and they have money. It's usually not a ton of money, but I mean, in terms of what they're willing to invest, but it's patient money. It's not like a venture capital, like I need to quadruple my money in 60 days or else it's not worth my time, right? It's people that appreciate it, maybe like what you're doing, or it's similar to what they're experienced in. Can also really help you with mentorship sometimes. This is where you're getting out there, you're making connections and trying to find these type of angel opportunities. They talk about like groups and stuff, but that's generally not where you're finding it. Most of the time it's networking and getting out there and meeting people and finding someone that might be interested. I actually just connected my dad with a business here in town that I think he'd be interested in investing in. So, he's in his 60s, he's retired from 2 oil companies, and, he loves to do like stock market investing. I thought, well, maybe he'd like to get involved in like a real hands-on company. He is one of my business partners, but he doesn't, he's a silent partner unless we do something he doesn't like, and then he's not. But that's running a business with your family. Right, I'm gonna get on full speed. I have to pick up my son from tennis in like 10 minutes, so we're gonna have to speed through this. So a little graph about angel financing and kind of the number of firms that get it and how much that is. They just like with any financing, you have to find a best fit. So that not everybody's going to say yes to you. It's not going to be a ton of money, probably. A lot of times they lose money, but the ones that they make money on, they make a lot of money on. So that's what they're kind of looking for, and why it's talked about as patient money. They talk about networks and stuff like that, but it's probably more going to be connecting with somebody that's interested in your idea. Again, getting involved in trade associations, things like that, or just getting out there and networking and kind of finding someone you connect with that might be possible. Venture capital companies. This is probably, I'm just going to be honest, not where you're going to get your money. They're at 400 across the United States, or probably more now. They're giving out $5 million to $25 million, right? That's not what most of us are looking for. Most of us are looking for, if we're going to start something small, not nearly that much money. And so they're looking for companies with high growth, high profit potential. When we talked about the Main Street buyer versus the serial entrepreneur, that kind of stuff. Figuring out where you fell in that category probably makes more sense if you would match up with a venture capital firm. Very rigorous review, less than 1% are accepted. I mean, most people don't. And actually, these businesses generally are not like brand new startups. These are people that are maybe in their B or C round of financing that get involved with venture capital. But, looking at this, 100 planes come in, 10 maybe get a closer look, 1 gets funded. Extensive due diligence, not usually, you're not going to get money next week or whatever. Most of it goes to companies in their early stage of development, and the companies that are in their rapid growth phase. 2% goes to businesses in startup or seed phase, right? That's not really where they fund. And so I think there's a misconception or a misnomer about what venture capital companies fund. It isn't really somebody just opening up. And so something to think about, and it's out there, and when you're going to hit it big, but we're looking at the difference between angel and venture capital investments, and you can kind of see how that breaks down. If you're getting involved in venture capital companies, they're looking for competent management, competitive edge, growth, industry, viable exit strategy. They want to know how they're going to get their return back out of it. They're not going to want to own this forever. I think about equity companies that buy up some of the aircraft companies here. They think they're going to make it run better and sell it for a profit. So that sometimes is not a venture capital, but an equity firm. Something to kind of similar. Corporate venture capital, a little bit different. It's companies that maybe are in your industry. So like if I'm going to do some kind of new light bulb and it's really going to benefit an energy company, maybe they would want to invest and then maybe have the rights to use it or something like that. So maybe you find yourself in a situation like that. Public stock sale. A lot of people think, I'm going to go public, I'm going to make all this money. And, that is totally something that happens, right? But we're talking about when you have $25 million in sales is when you make your IPO, right? It's not for somebody that opens up a corner coffee shop, which I'm sure you know, but it's a lot bigger company, I think, than I realized or than I really thought about. Scalability, high growth rates, strong record of earnings. You have to have 3 to 5 years of audited financial statements. The average company age is almost 10 years old. Sound management team experience, strong board of directors. I mean, these are established companies. They're not little startups that pop out there. And there's a huge, left steps to taking the company public, not because I want you to go through them or even know them. Just know that it's a significant process. It's not just like, hey, I want to be on the stock market tomorrow, right? So things to think about. Small business financing strategy. So banker, credit union, credit cards, earnings, family. So this kind of breaks down, where generally that's working. So now we're into debt capital. So, that equity stuff was really complex. I'm not sure. I'm going to have a little bit of money myself, but I'm probably going to have to get a bank, right? So these are usually smaller. They talk about micro loans, small loans from businesses, from banks. I guess that's the only slide I have. Anyways, so if you, so some people think I'm just going to get an SBA loan, right? A small business administration loan, because they loan to small businesses. Well, that is totally fine, but you have to go to a bank first and get rejected. So you're going to have to put together your business plan. It's going to be a lot more formal. You're going to have to take that information in there, apply for the loan, know how much you need and what you're going to use it for. And they're going to want to, the 5 C's of credit. They're going to want to understand your collateral and your, all your cash flow and all these things. And then, they may reject you. And so maybe you go around a few banks and see if it's going to work. It is cheaper to get a loan straight from the bank than it is to get SBA loan because there are fees and maybe a higher interest rate for them administrating it and taking on the risk, right? And so then if you can't get a loan from a regular bank, then you might go to the SBA. They'll need to see that you've been rejected from regular banks, and then they might decide, okay, or they might help you maybe a little bit get what you need to figure out. I mean, they don't reject loans for lack of collateral, so if that's really been the situation with banks, then they're really a good opportunity and option. You still get the bank loan. You still get the loan from the bank, but the bank now is more willing because the SBA backs it. So they'll say, if you default on the loan, then I will pay you, bank, 80% of that back. So you're not going to lose all your money. However, this is still a debt financing. The loan you still owe. Even if you default to the bank, you owe it to the SBA. They'll pay the bank back, but now you owe it to the SBA. So you're not out of it. So really something to think about, like equity financing. If you mess up, if it doesn't work out, you're just out the money, right? I just lost my whole savings or my retirement or whatever. But with the bank, which is horrible as well, bank financing, you still owe it. So, if you go out of business, you still got to make those loan payments. So something to think about. There's risk in all of that and coming up with the money. Certainly that makes people nervous. But if you've done a great job up to this point to get your plan together, then, it could be totally fine. I'm going to pause here. I'm going to go pick up my son from tennis, and then I will come back and we will talk about, you think I could do it? No, I'm going to have to pause. I don't think I can do it in 3 minutes. I will pause and then we will come back and pick up where we left off. Okay, I'm back. Now, last chapter or last section of Unit 5 that we'll talk about is managing your money as a small business owner. And so we've talked about how to set your prices. So now we're going to have revenue coming in. We've looked at our costs. We have a feel for what's going to go on with money management. We have figured out some funding, which, maybe these need to run in different orders because you'll want to figure out all your costs and things like that before you figure out how much funding you'll need to ask for. But as you get open and you start looking at your financials, you'll want to figure out how you're gonna use it, right? You can get QuickBooks or an accountant or a bookkeeper or something like that to put together your financial statements. I mean, I'm not going to teach you finance in this class. You're going to understand an income statement, and a balance sheet, and all those things from the classes you're going to take for finance. But what do I do with that as a business owner, right? I can be really great at finance and still not really know how to financially run a business. I mean, when I worked at the aircraft company in finance for 9 years, I didn't learn how to run a business with finance. I knew how to pump out reports and put together presentations and talk about financial statements, but I didn't, you don't get the full picture in that situation. And so it can be easy to not really know how to do that unless you have a plan for it, right? So we're going to figure out our way to run a business with our financials, right? Common mistake among business owners, they don't even collect or analyze their basic financial data. There is so much you have to do in business. And so sometimes people just, run their business by their checkbook balance, which can be really risky. You might not have any financial plan. Like, I don't have any goals towards, what I need to do in revenue or what my cost should be or how many, I don't even know if I should hire another person, right? Or how much I can pay them or if that makes sense or if that will make me more profitable or less profitable. 75% of business owners don't understand or fail to focus on those financial details of their company. The financial planning is so essential, and it's really not that hard. Like I said, financial statements can be crushed out of financial software that you're using already, and so it's just, what do I do with those, right? So there's three main financial statements that you'll use. You'll have the balance sheet, income statement, or profit and loss, and your cash flow statement. So when you're building up these statements, when I'm getting ready to open and I'll ask you, hey, put together a forecast, right? This is what we did in finance all the time. We were doing forecasts and then pulling actuals and comparing them and seeing if we were, better or worse than we thought, and then explaining why and trying to reforecast based on that data. So we're always looking at data. In a big company, you have a whole departments that do that for you. But in your own business, this probably is just you. And so you'll have to figure out, what your key drivers are, going back to, really understanding your business is going to help you, hopefully understand and use your financial statements more proactively than reactively. You can look at your financial statements and be like, oh my God, last month we did horrible. Or you can use your financial statements to say, okay, how do I fix this in the future, right? And so your balance sheet is where you're looking at your liabilities, your equity, your assets. Your income statement is where is the most common one. You probably understand that the best. There's even financial people that don't really love the balance sheet. It's a little bit more complicated and a little bit more elusive. I know that I had people in finance with me that didn't want to do the balance sheet part of it. Income statement, you get your revenue, your sales come in, you take out all your costs, you figure out, how much money you made, right? So sales minus expenses equals your net income. And so, or loss, which may be the case as you start a business. One thing you might think about in the financial picture as well is how profitable your customers are for you. So we're getting back to that target market again, but there are going to be some customers that really are not good customers. People talk about firing a customer, and I never perpetuate that idea, right? I think there is a value in almost every customer, even if they are difficult to deal with. They might refer you your next best customer. They might, later on become your best customer. I've seen that happen over and over again. And so I rarely end a relationship with a customer. But I will tell you, I could probably count on one hand customers they have now that would probably be okay with letting go because they are absorbing my details, they're difficult to deal with, they're not profitable for my customer, for my business. They might be people that I should get rid of. Sometimes there are people that are profitable, but they're not a good fit for your business, right? So I can do kid parties at the spa, right? So and maybe make money at it. Maybe I'll change my pricing structure and make them a great profitable piece. But the hidden liability in that is that it turns off all my other customers that are coming there to relax and enjoy a kid-free experience. So thinking about how there might be hidden liability, if I'm making lots of money selling Precious Moment dolls at Hot Topic, but now all my regular customers are like, what are these like old ladies in here getting these figurines for? I'm not going to buy that super weird shirt anymore here because it's not cool anymore. Hidden liability, things to think about. Target more, finding that customer that you hit a home run with that tells all their friends that, I can list names of people that come to my spa that I know, are my ideal customer because they send people, they spend more, they're willing to commit to my business. And then the ones that are a good fit, but you want to figure out how to produce, more profit with them, right? Whether it's cross-selling, getting them to come in and purchase your higher ticket items. I have customers that come in and do a little bit of business, like maybe they just get manis, and it would be better if they get massages and pedis and all that stuff too. So thinking about the profitability of our customers and how you can increase that. And then the statement of cash flows is the third financial statement, and that's where you're looking at your sources and uses of funds. And so my money and banking professor used to always say cash is king, right? It is something that you can't live without in a small business. If you run out of cash and you can't buy the supplies to make that next order, if you can't pay your employees the next payroll, then you're out of business. And so you have to manage your cash flows as a small business owner because if you're running tight on cash, that can put you out of business. So creating financial statements, this is something that you can just bust out of, you can put them into, well, hang on, I'm going to pause. Sorry for the pause. I think my dogs were eating treats on their own. So you project financial statements. This is where you get into some assumptions. They're well researched. They're realistic. If you just bust out like, I want to make $1,000 a month for the first 6 months, well, there better be something to back that up, right? I call that assumptions. You're gonna have to come up with some details, right? This is if I'm gonna open a restaurant, okay, and or some kind of small business is going to have hours. I'm going to have to figure out when I'm going to be open and when I'm not, and you're going to have to break that down. So if I'm thinking about, ticket price for breakfast is probably not the same average ticket price for lunch or for dinner, and so I'm going to have to understand, that, how much I will have to staff, what my hours are, what my volume will be. You'll have to know things about my menu at this point. I'm going to have to make assumptions. And so you'll need to know how you came up with that number. Peanut buttering that all across is not a good idea. At least have assumptions for your initial number, right? If I'm going to work up my number, my first month, I think, average ticket price can be $8 for breakfast and $12 for lunch. And I think, breakfast volume will be this, and, at least on weekdays and the weekends it'll be this. Split it up in a educated guess way. Don't just say, I'll do 1,000 customers a week, and, how'd you come up with that number, that just totally random number? And maybe there's research, you got into online research and you saw, like, breakfast restaurants see this many customers, and so you figured something up based on that. That's fine too, but you have to have some valid assumptions to build up that number. And then maybe you say, the first 3 months I think I'll run at this, and then I think I'll, increase my volume by 20, and that'll, or I'll have to discount at the first 3 months, so then I'll increase my revenue and my income by this much, over the next volume maybe won't pick up, but I'll start charging regular prices, really build up those assumptions. There has to be something behind it when you're building up your projected income statement, balance sheet, things like that. Sorry. And then once you have these financial statements that you've projected and that you're tracking, what do I do with it? How do I run my business with it? Okay, I made this much money. Like, what does that mean? I can look on here and see costs went up for salaries. Like, do I need to fire somebody? What am I doing? So ratio analysis can be really beneficial in terms of comparing yourself to previous months, previous year over year. We used to do all the time, or a benchmark for your industry, so you can get a feel for how those numbers are panning out, and running these ratios. So there are 12 key ratios, and they're split up into 4 categories. So I just kept the categories. You don't have to learn how to calculate this. Like, if I'm going to calculate them, I'm just going to Google how to do it, right? But you'll want to know, what they are and what's available, so you can figure out how you can use these financial statements and all these numbers you've put together to really figure out if there's an issue with your business, right? So liquidity ratios, you're looking at, can I meet my obligations? Like, am I getting into the red zone, like an issue here? So current and quick ratio, easy to calculate. Liquidity ratios, leverage ratios. So I'm looking at, financing provided by the firm's owners versus supplied by its creditors, right? Equity and debt, financing. Look at my debt ratio, my debt to net worth, my times interest earned ratio, just making sure that I'm not getting over leveraged. There's nothing wrong with debt. Like, having zero debt sounds amazing, but it also may, there might be tax reasons. I mean, debt isn't detrimental on its own, but if you get over leverage, that can be an issue. So these are ratios that you can look at. You can see, is this increasing or decreasing? How am I stacking up against, other competitors in my industry, my benchmark? So you can get a feel for if, some companies are more leveraged or not. So you can get a feel for how you're doing. Operating ratios, this is where you're looking at your overall performance, how you're putting your resources to work. Inventory turn, collection period, payable period, sales to total assets ratio. You're trying to see how efficiently you're using your assets, how long it's taking you to collect and to pay, and how quickly you're turning over your inventory. These are things that probably, all those probably, make sense and ring true, but they're things to track, so you understand. Like, they're not things you can just see plainly on your income statement and balance sheet, but they're things that you'll want to understand, that you can get to based on what financials you have available. And lastly, your profitability ratios. Now, this is where, if I'm making, one of the examples they used to have in the book, and I thought it was interesting, is they were interviewing 3 candidates, and they all ran different businesses. One was like a beef, one was a pork, and one was like a chicken company, right? And so, some had higher sales, some had higher, net income or whatever. And so the one you would pick just by looking at the numbers, like, hey, they made the most money, right? That's the winner. But then when you compared it to their profitability versus other companies, their benchmark companies, they were actually doing much more poorly than the industry called for. And so they weren't the best candidate. And so that's a reason why we're using these ratios, we're matching it up, we're really getting an understanding for what we're seeing. Just looking at the month by itself isn't as helpful as having, some ways to assess how that's working for you. So I'm looking at my net profit to sales, net profit to assets, net profit to equity, really getting an understanding of the information about your bottom line. So if you're operating efficiently. So those are the 4 categories with the 12 key ratios that you're going to want to look at. You might find that there are other things that you want to look at as well. We used to put together just a metric, and depending on what business you're in, you might find different ratios are easier, better to track. Sorry about the dog barking in the background. Ways that you're looking at the benchmark. I think we made it to the end. My dog is trying to murder someone in my front yard. Oh, she went outside now. Anyway, lots to think about in terms of numbers. Pricing, funding, financials. Just make sure that you spend the time on this just like you did with everything else. I'll post out there what's required for your group project in the financial area. And this should have covered everything that you might see in your quiz as well. So let me know if you have any questions. Sorry it was super long, actually.